Shall we?
So maybe we'll start with some introductions. My name is Eamon Gebre. I'm the head of advisory here at Sarwa. Thank you for coming all this way to make it today. Just really quickly about myself, I've been with the organization 2 years, just celebrated my anniversary, still waiting on that cake mark. Prior to Sarwa, I've been in the region for 12 years in total, worked with organizations such as HSBC, and also worked in banking in Canada for an organization called TD Canada Trust. My entire career has been working with individuals like yourselves, giving guidance, support, trying to demystify the entire investment journey altogether. And that's what we're trying to do today. I'm here alongside my boss, so make me look good today, please. Mark, who needs no introduction, it's all yours.
All right. So my name is Mark Shahwan, co-founder and CEO of Sarwa, and we're the region's leading personal finance app where we want to help you guys invest. And today we have a different twist to our typical mission to educate about personal finance. And we're going to be covering how to become a money-losing machine. So we really hope that you leave this session knowing how you can destroy more than 90% of your wealth as fast as possible. So unlike the usual content we do where we focus on how to generate wealth, we want to try a different approach where if you can uncover the biggest fails and the biggest mistakes in investing, it might actually be easier for you to achieve the same outcome. So one quote by Charlie Munger, who's the partner of Warren Buffett, who's very famous and one of the best investors in the world. He said, "All I want to know is where I'm going to die, so I'll never go there." And the approach is, if you are able to identify these mistakes that we see a lot of people make, maybe not Sarwa clients because they tend to be better, but if you can avoid these mistakes, hopefully you can come out stronger. So, but just to cover Sarwa very briefly, because we're going to be focusing on general investing content. We have 3 core products: Sarwa Invest, Sarwa Trade, and Sarwa Crypto. If you're a beginner, actually, can I get a show of hands on who is not investing today? Okay, a lot of investors already, great. So Sarwa Invest is for people that don't really want to invest in the day-to-day. They want to give that to someone to manage it for them, where we run everything, we invest your money in Rebalance. Trade and Crypto are products where if you want to do it on your own, they're best suited for you to be in the driving seat. And they're regulated by the FSRA. Sarwa Invest is regulated in Dubai. And a bit about Sarwa and our backers. Mubadala is one of our institutions. So despite being a tech startup, we're backed by some of the best fund managers in the world. And with that, we'll get started on how you can start losing money really quickly.
The best way I can think of right away is just bet it all on black. Like literally just go to the table, just put it all on one dice. Go all in on 1 or 2 stocks. That's the best approach, I feel, to make money. I mean, think of it this way. If I look at the stock market, if I've been looking back to 1925, it only goes in one direction. So how can I lose? Let me just pick a stock. I'll ride that wave. Surely there's so many different companies, and I'm smart enough to be able to pick the right industries, to be able to pick the right companies that have the right momentum. I can do a little bit of research. I'll just go to Google, figure out what's hot right now and jump into it. Is it a value stock or is it a growth stock? What should I do? But you know what? I think I'm fine. I'll be okay. I can't go wrong. The US market, if we look at it, it's been returning 10.4% per annum since inception, or since 1925 to be exact. So had I been around in 1925 and deposited $1,000, I would have well over $12.3 million. Odds are in my favor. If I did nothing and just left the money sitting in a bank account, I'd probably get closer to the treasury bill rate, which I can't even see that number, but it's about 3.1% is what you're looking at, T-bills. So if I had invested $1,000, I'd have $29,000 in my investment account. The thing is, a lot of us don't realize that only 4% of all companies that are listed on the US exchanges account for that growth. Again, I repeat, only 4% of all companies that have ever been listed on the US exchanges account for the growth that I've just shown you in the previous chart. More often than not, when I look at, sorry, let me go back. When I look at this chart, it's very easy to get, very optimistic and say, look, I can't go wrong. I'll just hold on to the stock. Surely this one that I picked out, which capitalizes on new technology, renewable energy, oil and gas, that's not going away anytime soon. I can't go wrong. But of the 25,300 companies that have gone through the doors of all US exchanges, 96% of them have not given you a return greater than the rate of T-bills. That's a shocking number, 96%. But I feel lucky though. Like, I think I can get it. Like, I'm pretty sure I can get it. I've been in the industry for a while, right? And I think audience members here, I feel like there's some lucky individuals as well. If you take a look, these are the top 10 companies, top 10 S&P 500 companies between the period of 1980 and 2020. This is a snapshot of what the top 10 companies were on the S&P 500 in 1980. You've got your, companies, your IBMs, you've got your AT&T, your ExxonMobil, Schlumberger, I have to say it like that because it's German, Shell, Mobil, General Electric, that was a big favorite in the 80s. Everybody knows these companies. Everybody's experienced them. They've purchased goods from these companies. Maybe your washer and dryer might be from General Electric. Now, if I was to play this video and watch the progression of these companies until 2020, by show of hands, how many of you feel that all of these companies will still be there in the top 10 in 20 years? Nobody. Very good. Smart crowd. 9? Maybe 9 of these companies, maybe disregard, maybe, I don't know, Mobil. Do you feel like 9 of these companies will still be there? No, very smart, very good. 8, 7, any takers on 6? 5? One not in the back there, perfect, thank you very much. That person works here for today. The reality is, when you start looking at how companies face adversity and how they perform over time, the sad reality is a company that's succeeding today doesn't assure its future. It doesn't assure their financial success. 20 years later, there's been a shift in the market where now all of a sudden, instead of seeing oil and gas, instead of seeing consumer staples, you start seeing tech companies like Apple and Microsoft. You start seeing Amazon and Google as being the top contenders on the exchange. How easy is it to predict? It's very difficult. There are, at this point in time, over 12,000 companies, 12,000 domestic companies listed on US exchanges. There's over 58,000 companies listed, international companies listed on US exchanges. There are thousands of options, but yet, statistically, 4% are the ones that give you the lion's share of the returns, and 96% don't. So to that I say, pick stocks. That's a great way to lose money. I'm going to hand it over to Mark. Oh, sorry, one more point. General Electric goes without saying, darling of American innovation in the 80s. They were in everything. We're talking about laser technology that they were, supplying to the US military. They were supplying washers and dryers to all of the households. They were in everything. And at one point in time, the stock price reached an all-time high of $465. They were expected to be the future of America. Today, they're just a shell of themselves. Companies being split into 3. They're no longer available on the Dow Jones Industrial Average. Things change, and stock picking tends to be a very dangerous game to play. Now I'll hand it over to Mark.
All right. So let's say you accomplished the first step and you made sure you only have 1 or maybe 2 stocks in your portfolio. The second step, if you want to really make sure that you don't diversify, is to bet on one sector or geography. So you have the illusion of being diversified, but you really, really don't. One thing that often surprises people is the performance of the S&P 500 from 2000 to 2010. Because we often use the S&P 500 in the investment industry as a way to highlight the opportunity. And a lot of people come and ask us, why would I use Sarwa, or why wouldn't I just put all my money in the S&P 500? And when they see the study, it scares them because they realize that 10 years can go by without any return. So if you compare the gray chart compared to the blue chart, where the blue one is representing emerging markets, you would have made 150% compared to a 0% if you had invested only in the US stock market. So this is interesting because ETFs is one of the best inventions in the finance industry. And a lot of people will, you might think that, okay, I checked off diversification by investing in one sector or one geography, but it's an illusion. You still have all your eggs in one basket, even if it's across so many different companies. So let's take a more recent example where one of my favorite, I guess, conflict in the, or from popular figures was between Warren Buffett and Cathie Wood. Warren Buffett is someone that's very famous, but if you're not familiar with his work, he very much is a prone of value investing and making sure that the companies he invests in generate a lot of cash flow and he can understand the financials of these companies. So you have companies like Coca-Cola, a lot of banks, and some of the companies we've seen in the S&P. Cathie Wood, on the other hand, is a more recent fund manager. She's really powerful in PR, very bullish on crypto. Was saying crypto is going to hit 500K, I believe, this year or last year. So really was able to gather a lot of the people that were betting on technology. And her, when we were all at home, stuck at home during COVID, her performance was 158% compared to 5.89%. And you had images like this one saying Warren Buffett is outdated, he's so old, he doesn't really get it. And she was seen as the new age fund manager that's going to make your money work much harder. But time is the best ally for the great investor. And basically, we've seen the rise, but also the fall of Cathie Wood. So ARK Invest is a fund that focuses on really innovating cutting edge technologies. And more recently, if you compare the road of wealth of Berkshire Hathaway, so that's Warren Buffett in purple, compared to ARK Innovation ETF, you'll see that, I mean, the chart is self-explanatory. You would have seen this crazy rise in your portfolio, and then you ended up much worse than if you had invested systematically with Berkshire Hathaway or with any diversified portfolio. So yet again, the point we're delivering here is that don't just think that if you're putting money in a fund, that you're pretty much good to go. And I don't want to start the education piece. I realize I'm gravitating to it. So the goal is to really make sure you lose, actually. So if you really want to make sure that you have a high chance of becoming a systematic wealth destroyer, you want to pick stocks, and then you also want to make sure you're investing in a fund that gives you the illusion that you're diversifying.
Now I feel like I want to change my mind. FOMO, and then this is a word that everybody has been saying for the last few years: fear of missing out. The whole idea is that your perception that you're missing out on something, so you take a very irrational and compulsive decision to participate in that activity. It could be something very simple, maybe a night out that you knew you had no business in going out that night. It could be maybe a birthday party. It could be maybe buying a really expensive car that you knew that was well out of your budget. It could be maybe buying a house because all of your friends are buying houses, so you decide to just jump on the bandwagon. That's FOMO. And I think each and every one can kind of relate to that story in some shape or form. We feel it. Well, this story, was very apparent just quite recently, just post the COVID period, the pandemic, where we saw this whole discussion about meme stocks and stocks going through the roof, going to the moon, diamond hands, you name it. Now, you would think that was just a historical event, but it still persists till today. Where, for those who aren't familiar with what had happened at that point in time, just to kind of give you a quick overview, there was a company called GameStop, and their primary, business operation is retailing games. So you'd go to the store, you'd buy a game, you can go back and sell it to them. They'll give you literally like 10% of the value, so with really high margins for the organization. And for many years, those lineups to get into these places. If you wanted to buy a video game, there was no other way that you would buy a video game without other than going to a retail store to buy it. I remember growing up, I used to go to Canadian Tire. That was my thing with my dad. If I wanted to buy a video game for my Super Nintendo, I would have to go there. But slowly things started to change with the advent of PlayStation, Xbox, and a lot of the game developers started giving the ability of downloading the game versus actually having to buy the cartridge. Well, that's a big impact to a company like GameStop because their primary business was retailing. There, you have to come in and they make a margin on selling games. Well, a particular hedge fund identified that this company was struggling, and they saw this as an opportunity to make money on the back of this company. And how did they do that? They shorted the stock. And for those of you who are not familiar with shorting, very simply states, or it's very simply, sorry, they sell the stock, right? So the mechanism of how they do that is basically the hedge fund borrowed the stock from the brokerage, sold it, received the proceeds. They were anticipating the stock to go down, so they bought it when it went down in value and returned the stock that they borrowed to the brokerage. And as a result, they pocketed the difference. And just to kind of give you some numbers, the stock is $100. I don't want to buy the stock. I want to borrow the stock from the brokerage. And then as soon as it gets down to $95, I'm going to borrow the stock. I'm going to sell it, take the $100 that's in my pocket. And as soon as the stock drops down in value to $95, I'm going to go ahead and basically buy that and return that stock back to the brokerage. And this is how shorting works. So this hedge fund identified that this company is weak and they wanted to short the stock because they realized that it can make a lot of money. But a group of young individuals realized that this was happening, and there was some study, well, I want to call it study, but there was a research thesis that was done by one Redditor who identified that there's an opportunity here for a short squeeze. And what essentially a short squeeze means is that these hedge funds who have entered into this short position have to cover their calls, basically, right? And what happens in that case is that if you buy the stock, you drive the price upwards. Well, that's opposite to what these hedge funds want to happen. Because if price goes up, then they're forced to be able to have to buy that, or otherwise they have to continue to holding onto their short position and paying interest to the brokerages. So here you have now a group or a committee of users from Reddit who are passionate about the company, passionate about the stock, but really more passionate about sticking it to the hedge fund because they knew that this is what they were doing. It was a David and Goliath moment where they said, I don't want this, the man basically taking down an organization that I grew, in that environment of buying games. So what they did was they colluded together, they bought stock and they bought some more, and that drove the price upwards. And that drove the price upwards quite considerably, especially considering that these hedge funds are required to cover their positions. And that basically caused an avalanche of the stock prices going up quite considerably. When you see how it looks on the chart, you're going to think that something miraculous must have happened during that period of time. What could have potentially caused the stock to go up 756% in such a short period of time? It's basically a short squeeze. It was manipulation on both sides to drive the price upwards. The problem with FOMO is that when people start seeing a stock going up in value really aggressively, everybody wants to jump in. Everybody says, this is my meal ticket. This is how I'm going to basically fund my retirement. This is how I'm going to fund that yacht that I want. This is how I'm going to achieve financial independence. And they start climbing onto that ladder and they start buying more, and that drives the price upwards even more. Unfortunately, there's always someone left holding the bag. Now, there were reasons why that the stock price dropped down quite aggressively. Still debated till this day whether it was something that was necessary, whether there was other powers that be, but that's not the point of today's conversation. The idea is that when you're jumping on bandwagons, because of the fact of FOMO, fear of missing out, you can get burned. And this repeats itself with AMC and more recently with Bed Bath & Beyond. If you're making investment decisions on the basis of FOMO, you have to reevaluate your investment strategy because these opportunities are going to come and go. And for every story that you hear of winners, you're going to hear 10 times more losers when it comes to stock picking. On that note, sell low.
All right. So let's say in step 4, you manage to buy high, as you would when you're typically getting in after everyone got in. To really make sure you drive the point across, we're going to cover the last step, which is selling low, panicking, and missing the rebound. And this is the most relevant to our time today, honestly. So loss aversion basically shows, it's a study that tells you that we don't value winning as much as losing. We really hate to lose as human beings, and we would rather not lose than winning. We're not really good at computing an expected value and being really rational with this decision versus this decision. We're typically going to avoid losses. That's how we're wired, and this is important for you to know, because if you really want to make sure you're losing, you need to really rely on that fear. So the pain from loss is usually a lot higher than the pleasure from gain. Now, let's start to look at some examples that can back this claim. So, in the S&P 500, if we look at it again for simplicity, during 2020, we saw the stock market go down by approximately 30%, and then it doubled from that March 23, 2020 till August, it almost doubled, which is really crazy if you consider that it was a short amount of time. But imagine that you were listening to all of the news, you were making sure you were tuning into CNBC, CNN, whatever, Wall Street Journal, that's telling you about um, the impact on the economy of COVID, etc. Who can blame someone that said, "I'm just going to, stay in cash until this settles and then enter"? So the point that we're making here is that as soon as we start to see our portfolio go down, and especially as that portfolio grows into thousands of dollars, hundreds of thousands of dollars with time, it could be really nerve-wracking to see your portfolio down 30%. And this is where your emotions kick in. This is where you want to start to sit in cash, where you start to question a lot of your portfolio allocation, and you want to do something about it. Very rarely are we gonna stay put and do nothing. We don't behave this way in any aspect of our lives, and we apply that same thing to our money. So let's look at another data point across a broader period of time. And a lot of you are already investors, so this one is a bit more technical. But if you look at the period between 1996 to 2015, so a very long period investing in the stock market, and if you see what is the performance of someone that did absolutely nothing and just bought the S&P 500, they would have returned during that period 8%. But if you start to say, you know what, I'm not feeling good today, I'm gonna enter the market just for one day and enter back in the next day. So if you miss out on that top one trading day each year, so I want to look at, if you during that 20-year period, if you miss out on just one day, the top trading day per year, just because you left the market and entered back in the next day, missing out on one day can cost you to go from an 8% return to a 2% return, which completely changes your financial picture. You would have to work more. You would have to, yeah, basically, you would have to work more, which is the point of all this. The point is for you to be financially free so that you can decide if you want to work or not. So every time you're messing with your portfolio, you're increasing your odds of missing that top one trading day, which is great because, again, we're trying to destroy the wealth. So imagine missing out on that one day, what it can achieve for us. This is another study that I'm going to quickly go over because I just realized it's been a lot of data we're throwing your way. But it basically shows that if you look at high inflation environments, which is a time we're living in, what happens to your portfolio during that period, and how did you end up? And the key takeaway is that in, I believe, 11 out of 12 scenarios, you had a very strong return. And in the one case where you didn't have a good return, it just took a bit longer for your portfolio to recover. So we're going to open it up for Q&A.
I was thinking, Mark, maybe we can kind of. So we've given the worst things that you should be doing, right? Maybe we should at least make sure that we give them the good points of what they should be doing, because I'm worried about a few audience members going home and actually following our advice right now. So just in case, liability, we're regulated. Let's just make sure we're on the same page. So rule number one, when it says pick one or two stocks, we're being satirical. Obviously, it's not true. Diversify. There's no question about it. Studies have shown time and time again, diversification is the keys to success. It is very difficult, if not impossible, to predict accurately which direction the market is going to go, which companies are going to succeed, which ones are not. It's very challenging to do it. And a really great investment tool that you can use to very easily diversify, make your life a lot easier, is using an ETF. That is the best approach to take. Rule number two, we'll take it.
Let's do it. Yeah. So rule number two, what we wanted to say is just be careful where you're not that you're properly diversifying. Properly diversifying is making sure that you have geographical exposure. You're not betting on Europe. You're not betting on the US. You're not betting on emerging markets more than the other. You're following an approach where you have access to all of these. In fact, we can also cover real estate. We don't need to just talk about stocks. A lot of when I moved in to Dubai in 2017, there was a very strong negative sentiment around Dubai real estate. Now it seems to be going back up again, but I often am surprised when people that have their income here, have all of their life here, also double down on real estate in property and think they're investing in something really safe and being exposed to the Middle East. So exposure isn't just about the stock market. I would also advise you to really consider the full aspect of your financial life, because the Dubai property market is also very volatile. It went through the 2008 crash, the 2015. So the whole point here is it's not one or nothing. It doesn't mean you shouldn't invest in property here. On the contrary, if you're thinking long term, it could be a very strong use case for you. But really ensure that you have exposure across the world so that you're not hit by one specific sector.
Thank you, Mark. For rule three, the FOMO slide itself, it comes back to, let's say that you're trying to go to Abu Dhabi and you've never been to Abu Dhabi before. You most likely will jump onto your Google Maps, figure out the direction to take in order to achieve your goal of arriving in Abu Dhabi. Similar to investing, it works in the same way. Identify what is it that you want to accomplish. Is it a nest egg for retirement? Is it subsidizing your child's education? Is it whatever it might be, financial independence, call it what it might be. First, start by identifying what that goal is. Then work backwards to figure out what the inputs are to generate that output. This, ladies and gentlemen, is called a strategy. And very simply, you follow your strategy, regardless of what's happening in the market, whether it's up, it's down, sideways, it doesn't matter. You follow this foolproof strategy of ensuring, number one, you have your emergency reserves set aside. Number two, any additional capital that you have beyond your emergency reserves that is not earmarked for maybe real estate or maybe some other goal that you may have, that money is considered idle money and is burning a hole in your pocket and losing out to inflation. You might as well just apply it towards your long-term goals. Number three, make a budget. Make a budget not only for your, just personal satisfaction so that you make sure that you have enough money at the end of every month, but to also be able to allocate money that you could put towards your long-term goals. Most of us here get paid on a monthly basis. That's an opportunity every month that you have to contribute towards your goals. I don't know about you, Mark, but I don't have a rich uncle who's going to pay and contribute to my goals. I'm responsible for it. And for as far as what we know right now is we don't have a national pension plan that we can rely on. So this is a great way for us to be able to build it for ourselves. So to that, I say it's a great approach for you to be able to work towards your goals. Just plan, work backwards. That's your strategy and stick to it.
Awesome. So that covers avoiding FOMO and thinking more of a journey, as Ayman is advising. It does mean it's a slower way maybe to get wealthy, but it's much more of a proven method. The last point that we wanted to convey is the most relevant for you today, which is to avoid staying in cash. And I'm really glad that we're doing this presentation today, because we just saw in the last 2 days, the market went up by approximately 6%. But if you really look into it, not much has changed in the grand scheme of things. So what we'd really like to hope is for you to avoid realizing that the stock market can be random and it's not always irrational. So the time that if you're going to wait until we have complete clarity over the political environment, the economical environment, how people are going to deal with the rates, you're running the risk of basically staying in cash and keep waiting for the next big thing. And before you know it, you missed out on so many returns just by being on the sidelines. So this is the really a strong point I'd like you to take away from that fourth step, so that you can be much more on. If you incorporate all of this, you have a defensive strategy, but you're also aggressive and taking advantage of a discounted price that can make you accumulate more units. So by the time things rebound, you'll thank yourself later.
We covered all the points, so maybe we should jump to Q&A.
Yes, we're gonna spend a bit of time on Q&A. Please, if you want to ask about investing, trading, anything, we'll do our best ability to do that. And we'll also have a bit of time at the end to just cover a bit more of a one-on-one. Thank you.
Yes.
Thank you for the presentation. I have so basically Sarwa is a fintech, a wealth tech. So I want to know the technology side, how Sarwa is using technology, and I want to know three important points about that. First is how are you? You must be auto rebalancing the funds that we are putting in. So how frequently you are doing that, and how are you doing that? So that's number one. Number two, within the ETFs, you said that you are investing in ETFs across all geographies. But how do you manage the correlations between those ETFs so that it doesn't get into one geography ultimately? So how are you managing the correlations between the ETFs? That's number two. And number three, you have it's a robo advisory, so you are taking questionnaire, you want to know my profile. How are you putting into different baskets behavioral profiling? How are you doing that? So these are the three things I want to know on the technology side. Thank you so much.
Sure. Thank you for the question. So the first part is, let's cover what's rebalancing and why it's important. And in the realm of our products, this is our Sarwa Invest product, where we do it all for you. Rebalancing is important because, let's say you do that questionnaire and the best suitable portfolio for you is 50% bonds and 50% stocks. I'm keeping it simple. If we take the 2020 COVID example, if you remember, we saw the stock market go down by 30%. Bonds weren't impacted as much, but we want you to be at all times at a 50-50 split. So what the rebalancing or the algorithm will do is it will trigger a rebalancing event, so that basically we move some money from bonds into stocks, because what the algorithm is spotted is that stocks are cheaper. So we want to buy when things are cheaper and sell them when they're higher, which is the complete opposite of how we're programmed. Whenever things are lower, typically we want to sell and we're afraid. So this is the great thing about rebalancing, is that it follows what Eamon was saying. You set up a plan and you stick to it. You set up certain rules and certain behaviors, so that if you don't feel like looking at the news for a week, a month, or years, you don't need to worry about it. The algorithm will make sure that it's looking for these opportunities and making sure that your risk is the same across many years, and sometimes you can keep your portfolio for a decade. So that's on rebalancing, and that's something we do for you. The second piece,
Which
diversification of ETFs, correct. If you remember, we showed the US stock market compared to the emerging market. So we look at the correlation to make sure that they don't all move in the same direction. And we have basically our investment team that looks at that, and we're going to choose primarily Vanguard and BlackRock funds. We think they're the best fund managers with the lowest cost, the best performance, the best liquidity. And we pick a handful of these ETFs and then allocate. We basically allocate a percentage depending on your risk profile, which is your last question of what makes up my risk profile. Why am I at 50-50? Why is my friend maybe at 70-30? And you might be surprised, because sometimes you have the same age, maybe the same job, but you'll end up with different portfolios. But the algorithm takes into account multiple aspects. There's age, there's time in the market. If you have, the more the better. If you're telling us you're investing for 10 years, this is amazing for us, because we know that you can go through certain cycles. You become much less interesting if you want to invest for a year or two, because we're gonna interesting from a risk perspective. We'll obviously you're still interesting, but basically we're gonna look at your age, your behavior, your stability. If you're self-employed compared to if you're employed, so all of these factors will recommend a certain score. The more risk you can take, the more you're going to find equities, and even be allowed some crypto exposure. So all of these factors are taken into account online without you having to talk to anybody. You can just do it through the app.
Hello. Thank you for the this interactive session. I have three questions. First of all, as you mentioned, Mubadala has invested in your company. I just want to ask in which channel or like what kind of resources they are giving to you from Mubadala. This is the first. And second, as we now see the inflation is still rising. So under this market situation, what is the investment strategy for like us, like an ordinary people to invest, for example, in Sarwa? And third, as you know, in DFC, there are so many fintech companies like Stashaway. They also had events before. So, you know, what is better? What is your competitive advantages than other fintech companies? Thank you.
Thank you. You want to take that?
You can cover the Mubadala one. I think you're probably closer to it, and then I'll cover the rest.
So Mubadala, for those that don't know them, they're 250 billion plus a sovereign wealth fund. So they invested in us as one of their few fintech portfolios in the region. And the type of support they give is basically they sit on our board, they're involved in the operations. And what's great about them is that they're large, so they typically follow on from the first round, and they continue to deploy capital as we grow. So this is what differentiates them from other venture capitalists, is they can play at all levels of our journey. So that Mubadala Ventures, yeah, their ventures are.
For the second part, with regards to inflation, because that's a hot topic at this point in time. There's no way you can avoid it. And I know it's making the headlines as far as what the U.S. inflation rate is, and everybody's paying attention. But a lot of us tend to forget about the UAE inflation and how that's impacting us. Undoubtedly, it's gone up. And last time I checked, it was anywhere between 4% and 5%. So don't quote me on what the exact amount is at this point in time. But we know that UAE inflation is also up. It's on the rise. We feel it in the grocery shops. We feel it when we're trying to purchase cars, gas, you name it. Everything has gone up in expenses. And the reality is that inflation is something that's persistent regardless of what economic environment. It's just that right now it's at a higher point. Typically, inflation is between 2% and 3% historically, but we're at a higher inflation rate right now, which means it's reducing our purchasing power much more aggressively today than it was maybe 2 years ago or 3 years ago. The only way you can counteract inflation measures or inflation impact of inflation is that you have to make your money work as hard as possible for you, but find an avenue that is in line with your investment goals or investment preferences. Some may feel that real estate might be an avenue for them. Typically, we've seen that in high inflationary environments. We also see that the rental yields will go up. So if you own property, then we'll see some of those rental yields go up. Unfortunately, buying real estate is not exactly the easiest for a lot of individuals because the capital outflow that you require to buy a property right now is quite significant. And also when you're factoring in the cost of purchasing a property, when you factor in mortgage processing fees, DLD fees, agency fees, it could be quite a bit for somebody to just jump in as a quick a solution to try to address inflation. We feel from our perspective, the best way you can approach this is simply just double down with your capital that you have available to invest. Just don't stop it. Continue, because this is your best avenue, your best chance that you have to be able to counter the impacts of inflation. So if you've already had an investment strategy in which you're funding your account every single month, continue. There shouldn't be any reason why you would stop it now. You'd continue. As I said, in all market environments, you invest up to your capacity in line with your goals. And that would say, in that case, is still the same, regardless of high inflation or low.
Amen. I just want to add, this chart was going to answer a lot of these questions, by the way. Inflation is the pink or reddish line at the bottom. So it's not the first time we've seen very high inflation. The answer to most of your question is going to be to really zoom out. And we've been through periods of high inflation. You just have to think long term, and you can see the delta between that $1,000 becoming $15,000 or 12 million. And so usually it's the fact that you're already investing is a way to deal with inflation, as opposed to just staying in cash and leaving it decrease, as Ayman was describing.
Remind me again the third question. Forgive me.
Stash away. Stash away. I'll start. Basically, the short answer I'll give you is in 2021, one of the best years in the stock market, their portfolio was down 15%, while the stock market was about 15%. I'm not going to pick on them particularly. You can make your own decision. But when someone does that, it means they're being an active fund manager. So if you're giving your money to an active fund manager, you have someone that's actively trying to beat the market. And 90% of fund managers fail to beat the market on the long term. So remember that 4% where you think it's already hard enough to beat the market or to make market returns, you're even decreasing your chances because you're giving your power to someone that thinks they can outsmart the market, which very often we're reminded we can't. So this is one of the main attributes. There's many aspects, including having access to trade, having access to crypto, having access to, soon we're rolling out a really cool product that you'll hear about in the news. So ultimately, Sarwa, what we want to focus on is you guys, is the UAE market, as opposed to how other many players that you'll see on Sheikh Zayed Road that have maybe one Dubai office, but they're really focused on a lot of other markets. We flipped it where we allow you to invest in global markets, but we're focused on people, whether you're Emirati or expats in the Middle East.
Tell me how you really feel. I just want to add one more aspect to that as well too. Is it's the people. And this is something that you don't have to take my word for it. If you just go to our Google reviews or any reviews that you might see, arguably one of the best customer support teams within the region. And I can say that very proudly and confidently. I've seen these people, in action. I've seen how they respond to our customers, and I'm very proud of the team. And I think that's something that makes us stand out quite a bit. Noman?
So I saw a previous slide that showed a comparison of the S&P 500 to emerging markets. I was just wondering when we could trade emerging markets on Sarwa.
So when you say trade, you talk about Sarwa trade specifically,
Yes.
Right? So good point. At this point in time, so the partner that we're using for Sarwa trade gives you access to any company that's listed on US exchanges. But that also means companies or overseas companies who are listed on US exchanges, you have access to them. But at this point, as far as accessing international exchanges, that's not a possibility at Sarwa Trade, but that is something that we're taking feedback on to try to basically materialize. In the end, we basically have to work hand in hand with our partners. So if they have access to it, then we will have access to it. Whatever tools and bells and whistles, we will also be providing to you as well.
Yep, thank you.
But please let us know what if there's specific markets. They might already be available through ADRs, American Deposit Receipts, where sometimes you have a stock, let's say, that's listed in Europe, that you can still buy on the US exchange because you have the stock that tracks its price. So that's an easy way that even today you can start to have access to hundreds of companies, if not thousands, that are not just listed on the US exchange.
Yep, thank you.
In the back, Ayman.
Hello. You're making me get my steps in today, eh?
Thank you. So I wanted to ask, for someone who is just starting out, right? Let's say they have a couple $100 they're sold on the idea of Sarwa. Now, should they, if they want to diversify, they don't have a lot to diversify with. If they only have a couple of $100, maybe you can buy a couple of shares of ETFs, maybe one or two shares of bonds or REIT funds. So for a person just starting out, should they diversify immediately with whatever they have, even if it's just a few shares of ETFs, REITs, or bonds? or should they double down on one of these products and then build the rest as they go along?
Avoid step one of the doubling down into one or two stocks. Make sure you're diversified. The thing I see with a few $100s, and I'm guilty of this too when I graduated and started working, is you start to think, okay, what's for me to get to these numbers that most often we see in thousands of dollars, you want to turn that in, you want to double it as much as possible. You want to, when you're playing with, when you're investing with smaller amounts of money, you have that mindset of that get rich quick mindset typically. So this is what you're really one of your challenges from what you're telling me, where stick to the disciplined approach, and as you build up, then you can start to have maybe 10% of your wealth or 20% of your wealth that's more into higher risk bets, but the majority of it, regardless of the amount, it will compound with time, and that few $100s will become a few $1,000s, and eventually you'll get there. So, but in terms of allocation, I would say try to have this core and satellite analogy that we use sometimes, where the core of your investments, or 80% of it, is diversified, and you have a smaller portion that's higher risk.
And just to add to that as well, so the beauty about ETFs is that your entry point is very low. So for example, with our Sarwa conventional portfolios, the minimum investment amount is $5, but that $5 is divided amongst thousands of companies all throughout the world. So you might feel that a few $100 is not a lot. It's actually a great start. You just got to continue and continue. And that's how you build wealth over the long term. Okay? Any other questions, folks? Yes, sir.
Thank you. I would like to know, if I buy stocks from Apple or some companies that pay dividends, will I get paid in dividends when they issue payouts? Or if I bought through Sarwa? And this is my first question. My second question is, will you consider in the future into metal, gold, silver that are, that I can purchase, which is actually backed in some treasury or something?
Thank you for the question. The first one around dividends, yes, of course. Depending on the stock, it'll pay out dividends usually quarterly. That'll be in cash if you're trading on your own. If we're managing your portfolio, we're going to be reinvesting these dividends into your portfolio. So again, we're not leaving money in cash, and you can reinvest it. So as much as possible, typically one-on-one will recommend reinvesting the dividends.
So on the Sarwa trade, the dividends will get paid to cash. You're responsible to basically decide whether you want to reinvest them, which is what we would recommend. But it's your decision on Sarwa trade. On Sarwa invest, it's automatic. It's a default where we reinvest your dividends for you according to your portfolio.
And on the second question regarding, I believe you're asking about gold, but maybe also something more maybe something more stable during these periods that are more volatile. So we have a gold exposure in our Sharia compliant portfolio already. So this is in Sarwa Invest, in our portfolio we'll have that. But if you want to go and get also an exposure to gold, you can also do it through an ETF on Sarwa Trade, where you can buy a gold ETF and hold it. So again, in both products, you'll be able to do that. It's just a matter of if you want us to do it and manage it for you, or if you want to be on your own. Of course.
Hello. My question is, what are your thoughts about SRIs?
SRI, socially responsible investing. Yeah. So unfortunately, it hasn't been too popular yet. It's a great offering. For those that are not familiar, it's basically you invest in the stock market, but you exclude certain industries, certain companies that aren't really doing well by the planet, or for certain governance reasons, or have been known for certain bad practices, or the tobacco industries. There's many versions of it. We do have an SRI portfolio if this is something you wish to get exposure to. The cool thing about SRI is that the correlation, if you look at it, it performs the same way as a conventional portfolio, which is sometimes something we don't think about, because we're used to, whenever we're buying organic, this is for you, Hannah, who likes to buy organic, you're typically paid. You have to pay a premium, and you pay more for a better quality, more sustainable product. But for SRI investing, it's actually the performance is there. It's the same performance, so you're not compromising on performance to indicate it. It's still very new. Not a lot of people are. We're not seeing as much uplift as we would like, but it's definitely a growing movement.
Hello. My question is about retirement. So once you already made your money, I won the $1 million lottery. What services do you provide for me to keep growing my portfolio as well as getting income on a regular basis?
So great question, by the way, because that's the ultimate goal for many of us, right? Is to be able to achieve that financial goal of financial independence. So the way that portfolios are constructed at Sarwa, they are geared towards growth, regardless whether it's a low risk portfolio, medium, high risk portfolio, just the mechanism, that the way we've constructed it, whereas where we're reinvesting the dividends for you, we're making sure that these are not, these are growth, securities that we have in the portfolio. This by design, it's meant to grow the portfolio. When you reach that stage, you have full flexibility to make withdrawals at any point in time, rather than setting up a, let's just say a fixed decision where you have to have, a certain income paid out from your portfolio. You're behind the driver's wheel. You decide at that stage in time whether you want to dial down the risk. So instead of being a more of a growth oriented portfolio, you might want a more income focused portfolio. So predominantly fixed income. So we have that option. And you also can control how much and how often you'd like to withdraw from the portfolio. So yes, by default, it's made to grow your portfolio, but you still have the ability to adjust it for your needs.
I'll also add, if you prefer to look at it on your own time, there's a retirement calculator. So if you write Sarwa retirement calculator, you can play around with a tool that allows you to see how ready you are for that step, and what you can do to accelerate it, or if you want to increase your income, what needs to happen, and then you can discuss that with a member of our team or Ayman to just go a bit more one-on-one.
We've got a lot of hands on that side.
Hi. I like the presentation. I think you flipped the script a bit. You started with the Charlie Munger quote, and it actually reminds me of another Charlie Munger quote: invert, always invert. But anyway, my question is more regarding position sizing. I know ETFs are the less risky investment to make, but let's say I'm convinced and it's all in my circle of competence and so on. What would you think is a good position sizing? I know this is a very broad topic and it depends on many factors such as risk appetite, but to be sufficiently diversified while going into stocks.
I mean, the what Mark mentioned earlier about the core and satellite approach, I find that to be a very effective one. And it's not something that we've even coined. There's studies that have shown this over and over again. So if you have some downtime, either speak to a member of our team or just Google core and satellite strategy. But just to kind of elaborate on this, the idea is that there are certain goals that you have are just non-negotiable, that they need to be achieved. And for that, a passive investment strategy works best, because if you have a long enough investment horizon, your portfolio will grow, you're diversifying, you're managing your risk. Typically, as a percentage, it's recommended to have at least 80% of your portfolio in a passively managed investment strategy. The remaining 20% is where you can take a chance. So when you talked about fixed, allocations and stocks, whatnot, the wise, adage is that you try to, not to invest more than you can afford to lose. And at least at 20%, you can take a little bit of a risk. You can invest in stocks that you're passionate about. You can take a chance on trying to beat the market, generate alpha. But at least at 20%, it doesn't compromise your goals, because 80% of it is invested in long-term growth funds. Does that answer your question?
Okay. To give you a data point, a Sarwa Trade customer will have about 20 stocks, which we're happy with. So, of course, that doesn't answer your question around the percentage. I think Eamon did a good job at that. There's no exact science. If you talk to someone in crypto, they'll be 50% in crypto, 60% in crypto, and they'll tell you to do that. So it really comes down to a certain level of risk tolerance. But our focus is to get there in a more with more probability than to maybe miss your chance and being too high risk. There's also your job. Like a lot of us, there's a lot of Sarwa team members here where you can take equity in a startup. There are many ways where you can have that bigger outcome without necessarily jeopardizing on your ability to diversify.
Hi. Let's say after maybe 10 years, 20 years, I meet my investment target. How can I take back my investments?
Yeah. So the question is 20 years from now, or similar to once you do reach your objective, what happens then? Do I withdraw all of it at once? Is there some sort of method? And it's true that it's not often talked about. We talk a lot about the earlier stages, but one concept we really like is the 4% rule, where ultimately there's a really powerful study that shows that if you withdraw 4% of your portfolio every year for a period, even if for a period greater than 30 years, and that's a portfolio that's 60% stocks, 40% bonds, or a variation of it, it will sustain itself. So what it means is that what you want to get to is, let's say, a certain number, whether it's a million. Let's say if we take a million, for example, and you're withdrawing 4%, well, then you just withdraw 4% or $40,000 every year. You adjust it to inflation, and you live off of that. So there's a very popular movement called the FIRE movement, financial independence, retire early, where a lot of people, in addition to investing, they start to reduce their expenses, and they get to see, what is this number? How much can I live off of? Is it 40,000? Is it 50,000? And then some of them even reach that maybe 500,000 in their 30s or in their 40s, and decide that they're ready to retire because they can live out of the portfolio. So the ultimate goal is that you live out of your investments. Whether you're ready in 10 or 20 years will depend mainly on you and your ability to accumulate as many units as possible so that you can then take some time off.
Hi, thanks for your time today. Is my capital more at risk if I was to invest with a robot with HSBC or Barclays compared to Sarwa?
No, because you are not taking, the only risk you're taking is market risk. We're not in the business of being a custodian. So the custodians of your money is going to be the likes of Citibank, HSBC, that will even be the custodians of the brokers we work with, such as Saxo and Interactive Brokers. So thanks for asking that. The risk that you're taking is from your investments.
Maybe last few questions. I think I'm starting to see some eyes kind of drowsing a little bit. Maybe a handful over here. To the very sharply dressed man.
The Shera today. It's a festival. Yeah. Right. So I've been using the app for about 6-8 months now, and I treat it like I invest in stocks, and I treat it like SIP. I mean, I just invest. I've never seen it go up in the last 6 months because it's only I'm trying to average out, but it's still down. But that's not the point. So currently for crypto, I'm using Binance. I would like to put it all together. Sarwa has done a good job by linking it to the UAE banks, so it's very convenient. Unlike IBKR, which is like a headache. Can I? I see now you have crypto on the app, but can you pay by credit cards? One is that. I'd like to know how it's a nice app, but what's coming in the next release in terms of financial reports? I don't see a lot of reports that I can play around with, so I don't know if my money is actually down or not. There are some charts, but that's not good enough. I need Excels where I can see the credits and entries, etc. Cool. Dividends are also coming, but it's too small right now. So, but yeah, just what's coming up next on the app,
I love that. That's good feedback.
I'll start. So on the on the market yeah, sure.
UAE stocks. Okay, excellent.
Got it.
You've
So
got to give it to us one at a time. We're like memory of a goldfish here. So forgive me.
no,
Oh,
it's
okay,
good.
got
We'll
it.
get you on one app hopefully. But the on the market performance, I know the pain you're experiencing. That's why we wanted to host this session to tell you it's part of the game. Experiencing short-term losses is unfortunately a cost that you have to incur for long-term gains. So hang in there, and as you've been doing, the basically around credit cards and debit cards, yes, this is something you're going to have access to soon. We do have a few members of our product team actually around, so I'll introduce you to them if you want to give more feedback. But as you nailed it, we want to allow you to have all of your assets in one place so that you don't have so many different apps to manage your money. On the UAE stocks, it's something in the pipeline. So, however, this is where we rely on our community and our users to really tell us what people want to work on more. When we looked at the UAE, now it's becoming a lot hotter in the IPO space. Before that, it was quite quiet, not too much liquidity. Yeah, so it's still early days, but if we see much more demand, that will definitely prioritize offering it.
There's a third one.
And there was yeah, on report Sarwa trade, you're gonna see it become much more robust. And if you've been using it for 6 months, you've seen some of the features we're rolling out, such as crypto. I would say you're expected to see it more robust without getting too complicated, like a lot of the other platforms that have just way too many graphs. So if there's specific reports you would like to see, let's chat a bit more one-on-one so that we can take that feedback. But in general, you can expect us to keep adding more to it every month or so.
Thank you. Sir.
Thank you. Guys, I love the app. I really do. I love its simplicity. It's one of the major reasons I use it over others. I mean, I do have across IBKR, for example, a bunch of others. I'm there because I'm there historically. I hate them because they're too complicated. But like my friend said, the reports, yes, I would like them. I'd like to, for example, calculate my zakah, for example, a bunch of other things. So that's one. Two, are you guys ever going to go native? There are some lags sometimes which are indicative of a web view app, if I'm not mistaken. So are you going to go native?
That's already in the works, but I'd like to hear. I wish I was technical and I can give you as detailed of an answer than the rest. But if there's specific things you're calling out, but we're already building with React Native, so that's already in the works. But maybe you're referring to something you're missing in the app.
Okay, great. Okay. Thank you. I can talk to you later. Thanks very much, guys. Oh, fantastic. Yeah.
We have some developers actually. Mo, I'm gonna come pick on you for that discussion.
Mo, you're gonna be our star today. Maybe take one last one.
Let's do it.
Anybody want to do the honors? There we go. Noman.
Not a question, but a thank you to the Sarwa team for organizing this. And you guys have put in a lot of good work over the last few months. Loved Sarwa Trade, so that's a big one from my end. So I mean, if the audience is with me, a round of applause for the Sarwa team.
He doesn't work here. I promise. He does not work here. He's a client. Thank you, everyone. Thank you very much, everyone. Have a wonderful evening, and we're around if you have any questions. There's also some refreshments in the back, so please feel free to go in either direction. Thank you.